The Wealth Tax Commission published their final report on wealth tax on the 9th of January. The wealth tax report was sponsored by the London School of Economics, and contributors actually numbered 50, and there were 36 evidence papers from a range of accountants, solicitors, administrators, and academics. So basically, why did they bother to consider a wealth tax? Well, because of the size of government debt. You've heard me speak about that before. It's large. So if you're considering government debt, and if the government are considering or may consider at some point an increase in tax, then the view of the Wealth Tax Commission was that if the government consider getting more tax in and what they can do to get more tax in, they should then consider at least a wealth tax to see if it could operate more effectively than increasing rates of existing tax. So that's basically the premise. The other premise that the Wealth Tax Commission worked on was that the role of government was to implement the will of the people, basically. And based on recent surveys and research done, it seems that the people are in favour of a wealth tax. So given that premise and the fact that debt is quite large, and if you're considering tax anyway, you ought to look at a wealth tax, then that got them thinking we ought to look at wealth tax again. It hasn't been looked at in this country for over 50 years. So the public said a wealth tax ought to generate revenue. That was the reason why you should consider it, to generate revenue to repay public debt incurred through COVID support. And it should also operate to reduce unfairness. There's a feeling generally, according to the surveys, that the rich have got richer, the poor have got poorer. They need to redress the fairness pot. But wealth tax should operate efficiently, should be difficult to avoid. That's the other point. Shouldn't cost too much, should be difficult to avoid. And then the Wealth Tax Commission added in their own little piece, which says, and it should also operate more effectively than other taxes. So there's the premise. So that set them looking at it, and now we've got their final report. Let's ignore an annual wealth tax. Broadly speaking, they said that's really difficult to operate. We've said as much in our past bulletins and videos. It's proven not to work that well in Europe, generally speaking. So forget the annual wealth tax. The big recommendation, if there is to be any form of wealth tax, according to the Wealth Tax Commission, is to have a one-off wealth tax. So just to answer some questions quickly, we cover all of this in a lot more detail in the bulletin, and the full report is also covered in the bulletin too on Techlink. There'll be further bulletins also analysing the proposals that I'm just going to briefly summarise now. So what should be subject to the wealth tax? This one-off wealth tax, all assets, no exceptions, everything, including your home, including your pensions, absolutely everything. Who should be subject to wealth tax? UK residents, according to the statutory residence test. And to avoid people who have just become UK resident having to then pay this wealth tax when they've only been here for a year or so, then they propose a backward-looking test. So it's those who have been resident in the United Kingdom for 4 out of the last 7 years from the date that the wealth tax, if it were to come in, came in. Okay, so that's broadly speaking who will be subject to the tax. I'll cover trusts in a minute. Most of the focus and the headlines would have been around how much this could generate. So the target is, let's get 260 billion, the sort of surplus government borrowing. How could we get that? Through a wealth tax, simply operated, a one-off wealth tax, okay? How much would you need to charge on that? So it's the rate and the threshold. So we're going to give some exemption, say the Wealth Tax Commission. And they don't propose or don't recommend a threshold or don't recommend a rate. They just give some examples. And the one that they seem to focus on most is an exemption, a threshold of 500,000 per individual. And that aligns neatly or just coincidentally with your combined nil rate bands for inheritance tax, 325 and 175. So 500,000 per individual. So a couple has $1 million exempt. Anything over and above that should bear a one-off tax of 5%, payable over 5 years if you want to. There's no real incentive for not paying over 5 years. So 1% of your wealth determined on a predetermined date, which will be a date before the wealth tax was introduced. So 1% per annum, a total of 5%. So if you were a couple and the threshold was £500,000, that's 500 plus 500, £1 million each as a threshold, which you don't pay tax on. You own £5 million worth of stuff. £4 million is subject to tax at 5%. £200,000 is your wealth tax bill, payable over 5 years. with interest on the deferred amounts. The interest rates are quite low at the moment. So that's broadly proposals around thresholds and rates, although different rates and thresholds are stated. For example, if each person had a £2 million threshold and the rate was 5%, then that would generate 80 billion, not 260 billion. So obviously less because the threshold's higher. So that's how that goes. How about valuation? That's quite difficult, isn't it? How do you value these assets? Well, houses generally not too difficult to value. Private businesses, well, they have to get their own professional valuation. So to add insult to injury, not only are you going to have to pay wealth tax on your business, but you have to arrange for the valuation to be done. How about pensions? Well, it's the cash equivalent transfer value for defined benefit, defined benefit pensions. So we could get that value and the value of a DC pension pot. What about liquidity? What about those with asset-rich, cash-poor? Then there will be provisions over and above the 5-year deferral, which everyone has a right to defer the payment of tax, and a special provision for pensions saying you don't have to pay your tax, your wealth tax on the pension bit until you take your pension, which could encourage people to defer taking their pensions, which has tax benefits anyway. And then the money will come out of the tax-free cash. So they don't propose a kind of scheme pay solution. It will come out of the tax-free cash, which effectively operates as a kind of tax on tax-free cash, because that's the way it would work. I don't know why, honestly, there should be some special rules for specific rules for deferring tax on pensions, and the other cases left to hardship rules that will be introduced, where you've got a house but not much money, you've got a small business but haven't realised the value on it yet. So that's all covered too. Trusts, how about trusts? Well, yeah, trusts exist and they earn quite a lot of money in the UK. Basically, all trusts in the UK that were established by a person who was UK wealth tax resident, basically resident in the UK at the point of determining value for wealth tax, all the trusts established by them at any point in their life will be subject to wealth tax. All of those assets would be. Okay, if the settlor could benefit under the trust, or their minor child could benefit under the trust, similar provisions here to the normal anti-avoidance provisions, then that wealth will be trust wealth will be aggregated with their wealth. Most trusts these days wouldn't be, would exclude the settlor, in which case they have their own kind of exemption, a bit like the discretionary trust regime. So you would tax the trust assets on their own. There's a lot more to it than that. That's broadly how it works. So there it is, broadly speaking, how the tax is proposed to work if there was to be one. You could raise a question, of course, as whether that target's actually right. Do you need 260 billion in 5 years? Maybe not. The IFS have said we'll need to redress public finances by 40 billion a year, not 260 to pay it all back in 5 years. So that premise may be capable of being challenged. One also gets the feeling the government is maybe more inclined to take a broader approach. They've issued very recently another consultation on getting VAT from sharing platforms like Uber, like Deliveroo, like Airbnb, some of which are situated abroad, to get VAT that they feel they should get on those transactions which they're not getting currently, to contribute towards repairing public finances. Maybe they're definitely going to review existing capital taxes because the OTS have already reviewed them. So a combined approach, looking at reliefs, looking at smarter spending. I think this overall approach, as opposed to a single silver bullet of a wealth tax, is much more likely. I'll add to that, you can never tell what will happen with tax, of course, these days, and in these strange times that we're all talking about. But even in the foreword to the Wealth Tax Commission's report, they state, and this is a quote from the Chancellor Rishi Sunak this summer, "No, I do not believe that now is the time, or ever would be the time, for a wealth tax." And that's been echoed by the Prime Minister. So that's been said quite recently. We know governments are prone to U-turns, but that does indicate fairly clearly what Conservative philosophy is. So I think an overall approach, probably more likely. This report will definitely be looked at, but we must keep in mind that it's a wealth tax commission that is not a government body. It's a very well written 126-page report with a lot of thoughtful stuff in it, a cracking good read, I would say. And we've done that reading for you. You can, of course, read it yourself in our Techlink bulletins, and we'll continue to follow up with a little more thought about what that tax could mean if it were introduced in the form it's being proposed. But I do stress, these are merely proposals and considerations in the context of a report from a think tank.